Good afternoon, ladies and gentlemen, and welcome to today's presentation, Power Options Strategy Discussion on Naked Puts, Cash-Secured Puts, a consistent way to generate income or to obtain stocks at a discount. It's great to see you all here, and I just want to remind everyone, of course, if you have any questions at any time during the presentation, when you logged on to the webinar, the GoToWebinar platform appeared on your screen. Inside that platform is a question pod, so just use that question pod to send over a question at any time. Now, before we begin our discussion into naked puts, we want to introduce what is Power Options. Well, Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. And our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance in over 23 of the most commonly used option strategies. After you've identified those positions, you can quickly further research and analyze the positions, compare the risk versus reward, analyze the stock and the option. And of course, we also offer a powerful set of portfolio tools to help you track, manage, and evaluate rollout opportunities or adjustments on your positions. Now, in addition to that, we do offer countless educational articles, help videos, archived webinars and tutorials to help you get more familiar with the tools on the site and the various options strategies as well. Ernie as a Renner created the Power Options tools over 17 years ago to trade his own personal account, but everyone here at Power Options uses these tools to trade their own personal accounts, myself included, so we have many more years of combined trading experience. For those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Renner and the Power Options staff for the past 10 years, 11 years actually. I handle a lot of the coaching sessions, webinars, and educational materials for Power Options. I have co-authored 2 books with Ernie, and I am versed in all strategies on the site. However, things such as naked calls, short straddles, short strangles, and iron butterflies, I've never used in my personal account. All right, now to begin, we're going to do a basic review of the naked put strategy. Then we're going to look at the Power Options tools for analyzing a naked put one stock at a time. In addition to that, using the search tool, of course, to customize our search criteria based on what we want to see. The naked put strategy is an income-generating position. We'll be able to generate a premium either on a weekly or standard expiration basis. This technique is also used to obtain stock at a discount. When we enter a naked put trade, we're going to sell to open a put option. That contract, we enter into an obligation where we may have to buy shares of stock at the strike price if the stock is trading below it. It is a parity trade to a covered call. The risk-reward profile is the exact same thing as an in-the-money call when looking at an out-of-the-money naked put. When we go out of the money, sell the put below the current stock price, an out-of-the-money put option, we do have the ability to have a decent downside protection. In other words, if we sell a put that's 5 or 6% out of the money, the stock can fall maybe 5 or 6% before we have to worry about management or before we start losing money on the position. It does offer limited upside potential. Based on the range that we set out of the money for the put option, we can have a high probability, but we do carry a potentially high risk with the naked put strategy. We don't have to purchase shares of stock. No stock is owned when we enter a naked put or a cash-secured put option, selling the put, again, to generate income or buy shares of stock at a discount. It is generally recommended that you do a cash-secured naked put, and we'll talk about that in a moment. Many investors are allowed to use margin when entering the put option. Now, the basic action of a naked put. We're going to look at a stock that we're neutral to bullish on, and our action is we're going to sell to open a put. That's the only transaction we're going to do. Typically, we want the put to be out of the money. In this case, out of the money relation to a put means below the current stock price. In order to maximize your annualized return, you typically want to sell a put in a shorter time frame. You can use weekly options. We'll talk about that later, some of the pros and cons of using weekly options with this strategy. But in general, you want to be maybe 20 to 45 days out in time. We typically don't want to sell a put that's 6 to 8 months out in time unless that matches your strategy plan and your specific goals. We should always look to sell a put on a stock we wouldn't mind owning. The contractual obligation when we sell to open a put is we may be forced to buy shares of stock. at any time between now and the expiration date if the stock drops below our put strike price. So we should only do this on stocks we wouldn't mind owning in our account for an extended period of time. Now in general, what we want to happen when we sell the put, of course, is we want that put to expire worthless, meaning the stock would stay above the put strike price at our expiration date. Now if the stock happens to be trading right at or just a little bit below the put strike price at expiration, we may be assigned the stock and that may be okay. Again, if we did sell the put on a stock that we wouldn't mind owning. The maximum profit of the naked put position occurs if the stock is trading above the short put. Now let's look at a basic text example of a naked put position, and then we'll look at the graph of it as well. Today, Ambarella, stock AMBA, is currently trading at about 58.05. We may look to sell to open the standard February expiration, the 20th of February, 50 strike put, and we'd receive $1.55 per contract. So if I sold one contract of this particular put, we'd receive $155 in capital into our account. Now, although we're not buying stock in this strategy, as we would with a covered call, a collar spread, or a married put, the broker's not going to allow us to do this for nothing. Okay? We're going to have to put up some money to cover the requirement if we were put the stock. So if I only sold one contract of this particular put, we would generate $155. However, because I sold a 53 strike put, we may be obligated to buy shares of stock at $53 per share if the stock is trading below at expiration or any time before expiration. So for 100 shares, or one contract that represents 100 shares, we'd have a capital requirement of $5,300 if we were totally cash secured. If you're trading naked puts in your account right now and you're using margin of, let's say, 50%, you'd only have to put up about $2,650 to do that. But of course, using margin on these strategies can be risky if the stock collapses or has a significant drawdown. The return and risk equations that we use when evaluating a naked put, when we sell the put, we collect a premium. The strike price is our obligation if we're cash secured. So the percent naked yield, the return that we would make against the cash secured requirement if the stock stays above the put strike and expires worthless, is simply the option premium we received divided by the strike price. For this example, our percent naked yield would be at 3% for about a 24 to 25 day trade. The percent OTM, the range out of the money of this particular put, well, it's $5.05 out of the money. Well, 505 divided by the 58.05, where the stock's currently trading, we are 8% out of the money on our put option. However, we do have a much lower break-even, or what's known as the percent to break-even. When analyzing a naked put, the percent to break-even reflects how far the stock can drop before we're technically losing money on the position. In this case, we are selling a 53 strike put option. We collect $1.55, so our break-even would be $51.45. And the percent to break-even, meaning how far the stock can drop from its current price of $58.05 down to $51.45, is 11.5%. So we've got a reasonable return and a strong downside protection or percent to break-even in the case of this potential naked put trade. Here we're looking at the profit and loss chart. When I took this screenshot, of course, the stock was up a little bit. It was at 58.16, but the premium was still the same at $1.55. So again, as we see with this basic profit and loss chart from Power Options, our original setup would be we would sell to open. Here we go. I'm sorry, folks. We would sell to open one contract of AMBA for $1.55. We take $155 into our account. It's an income generation. Now the monetary requirement, assuming totally cash secured, again would be $5,300, but as we see on the profit and loss chart, our break-even is $51.45. What would happen if we entered this trade, and on the 20th of February the stock was trading at $51.45? Well, we now have an obligation to buy shares of stock at $53 that's currently trading on the market at $51.45. At expiration, we could choose to buy to close this option. It is now $1.55 in the money, so we'd have to pay close to $1.55. That negates the initial premium, but if we were able to get filled at the intrinsic value, we wouldn't have a loss and we wouldn't have a gain. The other option, of course, we could choose to take assignment. We'd be forced to buy shares of stock at $53. We keep the $1.55 premium, so our total cost per share is $51.45. The stock's at $51.45. We could now choose to hold on to the stock if we expect it to move back up, or convert it into a covered call or a collar spread. We'll talk about that more when we get into the management techniques of the position. If the stock stays above our put strike price at $53, the put expires worthless. We keep the $1.55 premium. We would have had the $5,300, the cash secured amount, on hold between now and February 20th expiration to cover our obligation. That capital is now free, and our return off of our investment would be the 3%. We want, in general, to have the stock stay above the put strike price or expire within 0.5 or 1% above or below the put strike price, depending on our outlook for the stock and our expectations moving forward. In general, this is, of course, a neutral to bullish strategy. Again, a limited upside profit potential, but as we saw, there are a lot of positions we can find that have that 10%, 11%, or maybe even 12% to break even over a 20 or 30-day trade. So we have a reasonable downside protection, but of course, as you can see, the risk, if the stock collapses, is extremely high. This, again, is a similar risk-reward profile that you'd see with an in-the-money covered call position. If we bought the stock today at $58.05, when we sold the 53 put, or I'm sorry, we sold the 53 call for a covered call, we might get about $6.50, a similar monetary max return to the naked put position. Now, is this a good naked put? We're not making any recommendations or suggestions here on AMBA, but before we decide, is this a good naked put to trade, we have to look at several factors. Do our due diligence. First, does the underlying stock match the strategy sentiment? We want to enter into a position with a neutral to bullish stock, a stock that we feel is stable or potentially moving up in price. And again, we want to make sure that I'm entering a naked put on a stock I would not mind owning if I was suddenly put the stock early due to a decline in the price. Does the return in premium match our goals? We want to set realistic goals for any option strategy. In general, looking for strong, stable stocks that offer a good potential naked yield, we want to look for a 1 to 1.5% yield for maybe a 30-day trade. We just had a question come in, Raj, what are the best filters to identify fundamentally for good stocks? We're going to discuss that in a minute. I'm kind of going through this as a basic presentation for those of us that are not familiar with the naked put. We're going to wrap up the basic introduction in the next 5 minutes, and we're going to get into analyzing the position in a couple moments, and then using a search tool to identify positions from scratch. Now, the next thing we also have to check if the stock does match our sentiment, the return, the yield, and the premium match our goals, factoring in our commission costs perhaps. We also want to know, are there any events or news that might cause us hesitation for entering the position? As we saw with the previous risk-reward profile, we do have a large risk to the downside. Yes, we have an 11% to break even with this particular sample trade. The stock would need to fall 11% before we technically start losing money on the position. But if the stock falls for an unexpected event, can't plan for the unexpected, but we potentially don't want to sell a naked put if we have earnings coming up between now and expiration. Those of you that are more aggressive, and I won't advocate this, and we will talk about it, but maybe you're looking for higher premium naked puts with a much higher yield, and you're looking at positions on biotech stocks or things of that nature. We never want to do a covered call, naked put, or a credit spread on a biotech stock that has a phase 2 or phase 3 earnings coming up within the next, between now and the expiration date. Those stocks look like a great premium. You see the return that looks too good to be true, and it likely is. If they fail their phase 2 or phase 3 drug trial, you could see the stock drop 80% of its value in an hour, and trading might be halted or overnight, or the stock could gain 50 or 60%. So these types of strategies, a naked put is not something that you want to do for an earnings play. It's not something you really want to do for a, a high yield on a very volatile stock. You want to be consistent and look for consistent profits on stable stocks. You also want to check out the news events. If there's anything that might cause you hesitation to enter the position, such as an oil stock, for example, I traded recently, they were looking to expand their drilling and expand their operations into fields in Brazil and South America. Well, everything looked good, but all of a sudden, the Brazilian government came out and said that they were going to put higher taxes on land leased for different types of drillers and miners, and the stock took a significant hit because now that whole field production was in jeopardy. And so that's not a position I want to be in on a neutral to bullish strategy with a large downside risk such as a naked put or a covered call position, for example, or even a bull put credit spread as well. So let's do one stock at a time, and then we'll talk about the filters and use the search tool to address Raj's question. We're going to use the tools on power options, and when we're looking up a naked put position one stock at a time, I prefer to use the option chain on power options to evaluate my returns, my risks, my probabilities, and deltas, and so forth. Jerry, I'll get to your question much later too. That's in management. Let me explain how the presentation is going to go. We're going to navigate now over to power options, and we're going to discuss how I use the power options tools to analyze a naked put trade one stock at a time. Then we're going to come back. We're going to discuss the criteria that we feel you should look for when entering a new naked put position. We're going to implement that into the search tool. And then what we're going to do is talk about the management techniques. What are the 3 outcomes if you enter a naked put? And what you can do if those 3 outcomes occurred. So Jerry, your question about what about being assigned, we're going to address that later on in the presentation, probably around 12:45 or so as well. So that's the pattern we're going to go through this presentation. Let me navigate now over to the Power Options suite of tools. Okay, fantastic. And what we're looking at here, of course, is a basic trial setup for a Power Options account. And again, when I'm looking one stock at a time, I'm going to go into the Naked Put tab. This is where we can access all of the information for the various tools, strategy help pages, and discussions, white papers on different strategy techniques and evaluating naked puts. When I'm into the Naked Put tab, I want to go ahead and click on the option chain, and we'll type in our stock symbol, AMBA. Let's go ahead and click Get Chain. Now, before I do anything, we're just going to go to the standard February expiration. But I'm going to customize this view. When you first open this is just the 5-strike or the small put chain for AMBA. But I'm going to go ahead and choose columns. I'm going to customize my chain to look at the criteria that I'd want to use when comparing different naked puts on the same stocks. Let's go ahead and choose columns. And this allows us to choose a wide variety of different data that we can view. Well, I know, I'm just going to go through and check these off. I know I'm going to want to see the put price, the bid price. I may want to see the ask price as well. I might want to see some liquidity, volume, and open interest as well. Implied volatility, well, that's more advanced. I'm actually going to click that off for the time being. We'll talk about that later on. Delta, I'm going to remove for now as well. What I'm really going to focus on, how I'm going to set up my screen, we can add those back in later, the different Greeks, of course, and implied volatility and implied volatility ranges. But for right now, what I want to know is, what is my percent naked yield for the particular short put option? What is my naked yield annualized? That's important to know. I'm going to want to know the range in or out of the money. It's always good to know how far I am out of the money. My probability as well. And, of course, we're also going to want to see some other criteria there, such as, I'm sorry, where did I lose that there? It's percent to break even. I'll check to view as well. Okay, so that's sort of my downside protection. Those of you that are used to trading covered calls, the term for the percent downside protection on a covered call is typically called the percent to break even on a naked put. Let's go ahead and submit that basic view. So close the window to refresh the page. Okay, so now we have our basic information. And we talked about going 23 days out. And we can see that the stock is currently trading at 58.47. It's been moving up as we've been in our discussion today. But our 53 strike put still has a bid of 150 and an ask of 185. So it's still got a high premium. The percent naked yield be about 2.8%. It's a little bit lower now. It's basing it on 150 instead of 155 for our 53 strike. But we still have that 11.9% to break even because the stock had moved up in price. The theoretical probability that the stock will be trading above our put strike price is about 75%. In this case, it's 74.8%. And we're about 9% out of the money. In general, the percent range out of the money is a good factor to look at, but you're probably going to be focusing more, in my opinion, on the percent to break even. It's based on the premium you're collecting. It's showing you how far the stock can drop from its current price to your break-even price. So we could see almost a 12% drop before we're technically losing money on this position. Okay, and as before, we can take a look now at the basic profit and loss chart, or what we'd really want to do is look at our different research and analysis for this particular position. Now before I open a naked put, the one thing I might do, whether I identify it in the search, we'll look at that in a moment, or I'm here on the option chain looking one strike at a time, I want to go to the stock research tool. We know our expiration is on February 20th for our put option that we are analyzing. And we see that the next earnings, it's not confirmed yet, but we could look at other data sites, we might want to look at our broker, but we want to see when the next earnings are. In this case, shows the next earnings are around March 5th. Well, that's a good thing. I don't want to enter into a position where the stock has earnings between now and expiration. If Ambarella had an earnings date, let's say on February 13th, I would be hesitant to enter this trade because if the earnings come out, they're poor, and the stock drops 20%, I would be looking at potentially being forced to buy the shares of stock. We did have that 12% downside protection, which means that we'd be 8% unrealized loss when we're put the stock. Then we could convert it into another position, such as a covered call or a collar, to try to mitigate that loss. But if the stock continues to fall, unless we're in a collar position, the downside is still open. Okay? So that's one of the things I want to look at. And of course, this stock doesn't happen to pay a dividend, which is good as well. If you're interested in opening a naked put on a dividend-paying stock, you're going to want to take a look at the parity trade covered call. It might be better to be in the stock in that case, especially if you're going cash secured anyway. You might be better off being in the stock with a covered call position so you can get that dividend. We won't receive the dividend if we just have the naked put position because we don't own the stock. I do have several investors, Power Options, who specifically trade naked puts on stocks that pay a dividend. Hey, if they're put the stock, then eventually they'll hold on to it, convert it to a covered call, and collect the dividend. And they don't mind not collecting the dividend during the time frame that they're in the put or rolling the put and just in the naked put position. But if I'm looking at a stock that I'm looking at for this kind of risk return and it does pay a dividend, I'm typically doing an in-the-money covered call or a collar as opposed to the naked put position. Okay, let's go back to our chain real quick. And as you can see, the value that I feel for the Power Options chain for both covered calls and naked puts is we've customized it to show us exactly what we would see. And we could change the column order. I'd probably have the percent naked yield closer to the put ask price and then the percent to break even and then the probability. You can rearrange the columns as you want. But what I'm looking for here is this allows me to compare all of the different strikes to see directly what is my return for this 23, 24-day trade at the various strike prices. What is my percent to break even? Of course, what is my probability as well? So I'm looking at sort of a strategy page here, even though I'm just looking at a basic option chain, because we're showing you the important criteria that would factor in to a naked put investor using the chain. Of course, the other basic concepts we want to use, we talked about looking at the stock research to see if there's earnings coming up. I'd also want to, of course, look at the company information. I want to take a look at the recent news headlines to make sure there's nothing there that might cause me hesitation on a position. We talked about some of the unexpected events, such as, with the oil or mining stocks, land leases, things of that nature. Other things that we tend to look at, is there anything about change of board members, a boardroom scandal, or anything along those lines that might cause us hesitation. We also want to check the recent earnings. More importantly, we'd also want to take a look at the chart. And you can look at a one-year snapshot or big charts, and you can customize big charts based on various criteria that you want to use. For example, I'm going to select this to a 6-month chart, and I'm going to use the indicators of a 20-day moving average. I'm just going to look at Bollinger Bands as something that I use, but we can also select things such as MACD, RSI, fast or slow stochastic, for example, or just standard volume as well. Now let's redraw the chart. I'm just going to look at a 6-month chart. Now, we see that the stock has been moving up. What's key to remember when you're looking at a stock chart for this particular position is that we're looking at this particular strike. That's got sloppy there towards the end, but remember, we're looking at the 53 strike. So in the recent month, that's kind of close to a good support line, but remember, it's just broken above that recently, okay, right about here. So before that, it was down below 53. We had a pullback recently, but then it came back up, still showing strength. And it looks like it's been staying above that 54 line. So the 53 strike might be a reasonable choice. Oh, I'm sorry, I forgot to select something there. select SMA. My apologies. We're going to use the 20-day moving average since I'm using the Bollinger Band and Bollinger Band ranges. Again, let's draw that quick line here about the 53 strike. Now, everyone has their own different way of reading charts, and specifically what I'm looking for is, does this stock, the current pattern in this stock, match what I want to see? And what do I want to see? I want to see a stock that I feel confident with has the potential to stay above $53, or if it falls, it might only fall a couple points below 53 in the next 20 to 30 days. The stock has had a good trend. It's had some pullbacks, it's had some hiccups here, but it's been in a basically good trend over the course of the last 6 months or so. So these are the kind of things you want to look for. Now not everyone uses these techniques. Of course, everyone's a little bit different. One thing that might cause me hesitation for entering this position is the MACD line. Now you see the MACD line has just crossed below the signal line right about at this time frame, of course, so it's dropped down from that range when it was above 60, had a pullback, and so that's why it's down below there. Typically, in addition to following the trend, we want to look for places where the MACD has crossed above the red line, the blue line crossed above the signal line. As you can see here, when we see that crossover, it usually leads to a downturn in the price, and that's not what we want to see when we're entering a naked put position. So although the RSI looks reasonably good, the volume has been decaying as well. That's also something that might cause me hesitation. We want to look for good growth stocks, strong stocks as well. But that's just some of the things we'll want to look at when we're evaluating the position. Does this match my goals and my return? Yes. Could I potentially do the 53.50 or the 54 or the 55.50? Absolutely, depending on what my risk threshold is, my requirement for probability, and the minimum return I'm looking for a 20 to 30-day trade. Of course, if you're a shorter-term trader, you could easily toggle to look at the weekly options for January coming up in 2 days. We could go out to February 6th, which I believe is 8 or 9 days out in time. And we see with a 53 strike, it's only a 0.8% yield, but that's for 9 days out in time. So if we were able to get that 3 times, we'd be at about 2.4%, which is a little bit less than the 2.8, 2.9% we were looking for the 24-day out trade. So that's what we want to do, and that's why we'd also probably want to select to view the annualized return. Let me highlight that very quickly. For 9 days out in time, the 53 strike, 40-cent bid, 85-cent ask, well, this might yield a 0.8% naked yield for our put. Using the weekly options only 9 days out, we still have a 9.7% to break even. A much higher probability because of the shorter time frame. But we have a 30.6% annualized return with this weekly option. Let's toggle back very quickly to the February series, standard February expiration on power options. And our annualized return now for this particular position is 44.9%. It's one of those interesting scenarios where the standard expiration is offering a higher annualized naked yield and a higher annualized return compared to the weekly options. Typically with the weekly options, you'll see the higher annualized return as well. But that's not what we're seeing here with this particular strategy. So to be honest with you, even though it sounds great to do weekly series and generate premium week by week by week, looking at that annualized return, if over the next 23 days my confidence is still high that AMBA would stay above 53, I'm going to be tempted to stay with the standard expiration and not use the weekly because it's not maximizing my annual return on the position. All right, so that's just how I use the Power Options tools to identify positions one stock at a time. Use the option chain under the Naked Put tab. You can use a small chain on stocks like this. Just look at puts only, of course. That'll automatically be selected when you link to the option chain under the Naked Put tab. And choose your columns. Customize the field for your put-only chain to look at things such as the percent to break even, percent naked yield, annualized naked yield, the probability. Of course, you always want to see the basics of put price and ask price. And as we saw before, I might also want to look at the option volume and open interest for the various strikes in the different expiration time frames. And at the same time, if you wanted to get more in-depth, you could look at things such as the delta, gamma, theta, and vega as well. We're not going to discuss those in depth right now. We're going to talk about them a little bit when we go into the search tool, and I'll point everyone later to the presentation we did on analyzing the Greeks for different positions that's already archived. All right, now if you have any questions about what we just reviewed, please feel free to send those in. I'm going to navigate back to our slide presentation here to review some of the things that we just talked about. What is the type of underlying stock we want to look for when entering a naked put trade? Well, we want to look for a stock that's in an uptrend. We want to look for a stock that's maybe trading above the 20 or 50-day moving average. You may also choose to look for stocks that are trading, where the simple moving average, the 50-day SMA is above the 100-day SMA, if that's your criteria. You might want to look for a stock that has that positive MACD or the range of RSI if you use RSI to evaluate overvalued or I should say overbought or underbought securities. Neutral to bullish criteria. What do we mean by that? Well, I want to see stocks that have shown good management and have reflected good growth. I want to look for stocks that have grown in earnings. I probably want to look for stocks that are actively traded, have a reasonably high average stock volume, and maybe only mid to large cap stocks. I do want to avoid earnings and potential other events. Next dividend date might not be an event you want to avoid, but you do want to avoid earnings, and you want to research the stock to make sure there's nothing out there. Another example might be a pending patent lawsuit where the judgment is expected between now and the expiration date of your put option. And we talked about quality stocks, stocks that have grown in earnings, mid to large cap stocks. And the highest premium is not always the best trade. You look at two different stocks, both trading at around, let's take Ambarella for example. Two different stocks, both trading around $58 per share. Look at the February expiration. The 53 strike 23 days out for Ambarella is offering a 3% yield. But then we see stock XYZ trading around $58, 53 strike to February 20th is offering a 7% yield. There is a specific reason why that yield is double what we're seeing with the other position. And it's because the implied volatility is high, which usually means there is an event coming up that could be earnings, pending patent lawsuit, or the stock has just been extraordinarily weak and everyone's speculating that the stock's primed for a fall or maybe primed for a gain in the other direction. We don't necessarily want to take those high risks for the high return because remember, just looking at our basic profit and loss chart for a naked put position, let's go back a couple slides here real quick. There we go. We're just looking at the basic profit and loss chart of our naked put position. If we have a stock that offers a really high yield, speculation is that the stock might be falling or it might be moving up in price. There's some event that's a catalyst. We don't want to get into a security that has the potential or the risk to drop 10, 15, 20% or more. Even though we have that strong percent to break even, we don't want to be stuck in this range. We don't want to be put the stock and then be forced to manage it for probably 6 to 8 months to try to get back to break even. Okay, Theo says that analysts projected one-year target is 57.91, so in their view it's overpriced right now. I would not take this short put. Okay, but that's fine. Like I said, everyone has their own examples, and Theo just provided us with some information that would cause him hesitation to entering a position. Again, if you use analyst predictions and target prices, that's great. I specifically don't. I use my own chart reading techniques and my own patterns. Everyone has their own way of doing it, and that's great. So let's, with what Theo just mentioned in mind and what Raj had mentioned earlier as well, talking about the different criteria, let's move forward once again, and let's talk about the basic option criteria. We talked about the stock criteria we want to look for. Let's talk about the basic option criteria as well. When selling a naked put, we saw the risk-reward profile. We want the put to potentially expire worthless for the maximum return. Again, we should only be doing this on stocks that we wouldn't mind owning, so we're okay if the stock is put to us. But to start, we're usually going to sell a put out of the money. For standard expiration, what we looked at with February, maybe 25 to 45 days out in time, I'm going to want to go maybe 5 to 7% out of the money. I'm going to use a lower range, of course, if I'm using weekly options. I can't expect to go 5 to 8% out of the money with only a 7 to 10 day time frame to expiration and still get a reasonable return. So to still have the goals that I want for return, if I'm using weekly options, I'm probably only starting off looking at 1 to 2% out of the money. The premium and the return have to match our goals. Okay, I don't want to sell a put option that's 30 days out in time if it's only offering a 0.5% yield because it's a lower volatile stock or a basic ETF that doesn't offer a lot of premium. If it doesn't match my goals, I'm not going to do it. I want to have a reasonable probability in that percent to break even. That Ambarella position usually has a higher percent to break even than I normally expect to find. In general, when looking for 30 to 45 days out in time, I'm looking for a minimum of maybe a 1.5% yield on my naked put position with a percent to break even of around 6 or 7%, going 5% out of the money. And of course, I want good liquidity, not only just on the stock as we mentioned, but also on the option as well. I want to make sure that there's a good open interest, it's actively traded, and I'm probably going to want to look for contracts that have traded today as well. All right, so all that being said, let's get back to what Raj wanted to see and what we talked about earlier. Let's talk about applying the stock and option criteria to the power option search from scratch. We're going to take a look at standard, expiration, and weeklies as well. Bill says, are you consistently looking for 3% per month? No, I'm not. You can, if that's your goals. What I found over time, trading in naked puts, I go in and out of them occasionally. For the first, we had mentioned earlier, I've been trading for 12 years in options with Ernie here at Power Options, trading my own account. I traded naked puts for about a 3 to 4 year span, back, of course, about 10 years ago, back in 2002 to 2005, around those ranges. Consistently looking for 3% per month. What I found is realistic. During that time frame where I was actively trading them with a larger portion of my portfolio, I found that 1 to 1.5% return is what you'd expect to make. Now, that being said, Bill, what I mean by that is that factoring in all the losses and the stocks that went against me, stocks that I was put and had to manage, I would look for puts that maybe had a 2 to 2.5% naked yield during a 30-day time frame. Of course, naturally, when we're talking about 2002, we didn't have the weekly options available. But when you factor in the losses, when you factor in the stocks that are put to you and you're managing over time to try to get back to break even, year after year we'd see that there's about a 1 to 1.5% total gain. There are investors that do better than me. I'll admit that. We're going to show how the tools can help you match your goals and what you're looking for. But with a naked put position, a naked put strategy, I do not have the expectation to make 3% per month. I'll find naked puts that offer that 3% time value and that 3% naked yield. But when you factor in, let's say you do 10 to 15 trades per month, when you factor in the break-evens, the gain or losses, you're probably averaging 1 to 1.5% per month. That being said, a lot of you may have been doing this particular strategy. I know some of you are. I see a lot of familiar names there in our results here. But a lot of you have probably been doing the naked put strategy or covered calls from, maybe let's say January or December 2013 or January 2014 up through the summer of August and September before the volatility started to kick in and we saw some weakness in the market. And you were probably doing extremely well. But what's the other key? The other key, of course, is that if the market's been bullish for an extended period, 6 to 8 to 10 months, well, there's not a lot of fear, there's not a lot of hesitation, there's not a lot of volatility. And what that means, of course, is that you're not going to see a lot of premiums. The premiums I can receive now are probably slightly higher for naked put trades than I could have received in February of 2014 or March of 2014 when the market was on a strong run. It was still bullish and there was not a lot of fear in the market at that time. It started to creep in around August and September and into October of this year before we switched to 2015. All right, so we're back on power options now. We're going to take a look at the naked put view, and we're going to go right into the search screen. Anytime you open the search in a given strategy, you're going to see a list of default criteria that match one of the default searches listed below. Here we see the weekly series, of course, and there's Ambarella again up at the top. The stock is at 58.27. It's a different strike because we're 9 days up. We see we could sell the February 56 put for 115 with a 2.1% yield, and of course we have a 66 or 67% probability. Again, I'd probably customize my view, choose my columns to see which field's best suited the data that I want to view. All right, now let's scroll down below the listed trades, and we see here that we have a default weekly naked put screen that you can use as a stepping stone to create your own personal search. The other default searches you can use as a stepping stone, the initial values, power options out of the money. It follows one of the articles we've written, and then there's a tip sheet one that follows the tip sheets. Let's just look at the basic initial values. This is looking out to that standard expiration, February expiration, and now it's at the 53.5 strike that's offering that 3% yield. So it's changing consistently as the market's going. We're seeing different results. Now we see a wide range of naked yields for our first 20 results, everything from 1.3 up to 4.1%. Now we might say, does that 4.1%, since it's the highest naked yield, is this the best trade? Again, I don't know. I'd want to go ahead and use that more information button to do the research and analysis we just went through, looking one stock at a time. I want to make sure the stock's going in the trend that I want. I would set criteria to help that in this search. I'd also want to make sure I'm comfortable with the stock chart. Ambarella, we'd already talked about. Theo had mentioned that his one-year price target was 57.91 on the analysis he uses, so he's not comfortable with the 53 or the 53.5 strike put option. And that's perfectly fine, but for a 23-day trade, if I feel comfortable that this stock's not going to drop 10 or 12%, the 5 points, this is still going to be a reasonable trade for the shorter time period. All right, now let's scroll down below our listed trades. And we see here that we have our initial value set criteria. We have 4 different sets of criteria that we can set, about 15 to 20 different criteria in each set. So we can set our options criteria, the stock technicals, stock fundamentals, or you can choose to screen against a specific stock list. In this case, looking for neutral to bullish stocks, I might use something such as the S&P 5-star list or the S&P 100, for example. A company lists some of the ones we provide that are neutral to bullish. You could choose just to screen against ETFs as well. I'll walk through doing that briefly also when we get more into the search tool. You can also create your own personal stock list. If you have a list of stocks, 30 to 45 stocks you track on a general basis, you can create your own personal stock list and screen against those. I'm not going to review the criteria that are being shown here. You can always see what our criteria are when for one of the default screens in the active filters menu every time you open a search. But we're going to start from scratch. I'm going to go ahead and clear filters. And that's going to empty everything out of our criteria field. Now to start, let's use a standard monthly expiration screen. I'm going to select my options expiration time frame just to February. I'm not going to concern myself with time value, implied volatility or implied volatility ranges, overvalued or undervalued options, but I'll explain why in a little bit. We talked about our personal goals for a 20 into 23 or 45-day trade. So I'm going to set my percent naked yield here to 1.5% minimum. And let's start off with our percent to break even. Let's go to at least 7%, meaning that the only positions I'm going to see are those positions where the stock could fall 7% before we're technically losing money on our naked put position. Now the percent to break even, the range out of the money, and the probability sort of all go hand in hand, but I'm actually going to use all 3 combined together. So I'm going to set my limitation for percent range out of the money of at least 5% from the current stock price. And my probability, we'll start off with a basic view of at least 70% or more. Strike price I'm not going to worry about because I'm not trying to pinpoint a strike price. I want to see a wide range of potential options. Black-Scholes ratio, similar to IV over HV and IV over SIV, is the option considered overvalued or undervalued. Not going to use that. Delta. I'm not going to use delta. And again, these are all things I'm going to explain in a little bit, but I'm not going to use delta. However, if you did have a preference where you only wanted to sell puts that had a delta of, let's say, 0.3 or less, 30% or less, you'd want to put in a field of greater than negative 0.3 in this case. Okay, so we're looking at puts which have a negative delta, so I'd look for a delta of negative 0.3. Would only show me things negative 0.3, negative 0.2, and negative 0.1. I have to kind of think reverse here. I'm going to leave that alone for now. And we talked about our basic requirements for option volume today. What are some of the settings you might use here for liquidity? Well, you know your account size better than I do. I know my personal account size. And you know in general how many contracts on average you trade in a position, whether you're doing naked puts, credit spreads, or so forth. So as a general rule, if I'm trading a minimum of, let's say, or an average of 5 contracts per naked put position, I'd want to look for a minimum option volume today at least 5 times the number of contracts I'm planning on trading. So I'd look for an option volume today of at least 25 contracts. I'd probably want an open interest minimum at least 10 times the number of contracts I'm planning on trading. So I'll set that to 50. Okay, so do we put anything extremely advanced in here? No, we put in our downside protection range. Some of you may be familiar with that from the covered calls. We call it a percent to break even in the naked put strategy. I put in a minimum yield that matches my goals for my trading strategy. I know I do want to be at least 5% out of the money. I'm looking for a probability of 70% and a basic option volume and open interest. Now, let's move on to the stock fundamentals. One of the things I mentioned earlier is that we prefer and we advocate that if you're doing the naked put strategy, you want to be totally cash secured. You don't necessarily want to do these positions on margin because if you have a stock that goes against you, well, you can be in a lot of hurt and you can lose a large amount of money. But we're going to treat this sort of as a covered call or collar position based on my account size. If I'm going to be cash secured on my 5 contracts or 3 contracts, I'm probably only looking for stocks personally that are between maybe $5 to about $75 or $80 per share. If you have a larger account and you trade stocks up to $200 and you're doing cash secured and you go that range, just put in the range that you want to see. Now, I'd mentioned that I prefer to look for stocks in any neutral to bullish strategy, whether it's a bull put credit, calendar call spread, debit spread, bullish debit spread, covered call, collar, married put position, naked put position. I want to look for stocks that have shown positive earnings growth. Okay, I want to see stocks that have shown good management. So in general, I'm going to look for an earnings per share growth on the stock of greater than 5% from last year to this year. And in general, I like to keep my PE ratio around 0 to 70 or 0 to 50. It's personal preference. You don't really have to use that. Some of the other things I know I'm going to look for is the earnings date. Well, I don't want a stock that has an earnings date between now and expiration. I don't want to get stuck with that sudden surprise and have a stock that drops 20 to 30%. I'm not going to worry about the ex-dividend date, but you could select that as well. And in general, we have the market cap field here, and it gives you a basic view of the filters that we use because it's measured in thousands. So a small cap is considered 0 to 2 billion. On the filter size, that would be a small cap range of 0 to 2,000 for the filter. When doing these types of strategies, neutral to bullish strategies, that have this risk, covered calls, naked puts, again, even bull put credits, I'm probably only looking at mid to large cap stocks. So I'm going to put in a market cap of at least 2,000 or greater. All right, now that's all I'm going to use for this particular field. We're going to move back to the stock technicals as well. And I want to mention liquidity. In addition to mid to large cap stocks, the average stock volume here, this is measured in thousands. So if I wanted to look just for stocks that trade an average of 750,000 shares per day over the last 90 days, we'll just put in a range of 750. I could use the average broker recommendation. I'm not going to worry about that. That's based on the Zach scale where 1 is a strong buy, 2 is a buy, and 3 is a hold. In general, I might look for a broker rec of less than 2.6 to only look for stocks that are recommended at buy, between a hold and a buy or a strong buy recommendation. And you can use the RSI as well if you want to look for undervalued or overvalued positions. I'm specifically now just going to look for a simple moving average. I'm not going to look at Bollinger Bands or the MACD. I'm just going to look at stocks that are trading above the SMA 50. Now, why am I using the SMA 50? Well, it's because I'm looking at the standard expiration that's 23 days out in time. So I want a stock that over the last 50 days, twice the time of my expiration, is trading in an uptrend. When we do the weekly search, I'm probably going to lower this down to stocks that are above the SMA 20 instead of the SMA 50. As I mentioned, even though we talked about what I use on the MACD, I'm not going to use it at this time. Let's review very quickly. As I make different adjustments to the search, to the active search, we see that our active filters here have changed. They're highlighted in red now because we haven't activated them. Did it really do anything all that advanced for this particular search? Well, I had to put in a stock price range that matched my criteria. Yours might be a little different. That's perfectly fine, and that's assuming cash secured. But I'm doing a neutral bullish strategy, so I want to see stocks that have a good earnings per share growth. I want to avoid earnings because I don't want to see that significant loss. I want to look for mid to large cap stocks, stocks that are in an uptrend, and stocks that are greater, of course, than 750,000 shares per day. So I'm looking for strong liquid stocks that have shown good earnings, and then we have our option criteria. Minimum return of 1.5% for a 20 to 45-day trade. I want that percent to break even to be greater than 7%, reasonable probability, and some liquidity. Not a lot of advanced stuff here, is there? We're not looking at delta, gamma decay, IV over HV, overvalued or undervalued. Let me go ahead and submit the search now, and let's see what we get. Wow, that's pretty interesting. We are in an earnings season, but based on our requirements, we only have 2 positions, GameStop and Kate Spade. Now, why is before, when we ran the default search, we had many more results? We had about 23 or 24 results. What's hindering this particular view? Well, I'd say more than likely it's probably this field here with the stocks in an uptrend. When we looked at the chart for Ambarella, everything else matched our criteria. We had that lot higher than average naked yield. We did have that higher percent to break even that we were looking for. We did have the probability we wanted. We probably had the volume and open interest we wanted. We know that Ambarella probably trades at least 750,000 shares per day. It is a mid-cap stock. They might not have had a positive earnings growth. Actually, they had a 14% growth in earnings. So it's likely that because of the recent market trend and the recent market conditions, there's only 2 stocks that are trading above the SMA 50. put that to the test very quickly. I'm going to go back into our technicals, and we'll just change this now to none versus none, and let's run that search. Okay, Amberella still didn't appear in our results, but we have more results. So we saw GameStop and Kate Spade. We're in an uptrend. U.S. Steel matches our requirements for the other stock criteria, but it doesn't match what we're looking for as far as stocks in an uptrend. So that's why it didn't appear in our results. Okay, so this is a basic screen that you can use. These are some of the suggestions and some of the criteria that I would use. Now, a lot of you, when you delve into options trading, you're thrown a lot of terminology for delta, gamma, theta, vega. Look for overvalued options, options where the applied volatility is greater than the historical volatility, or where the Black-Scholes ratio is extremely high. With this basic search, even though we only have 6 results, we did remove that criteria for stocks trading in an uptrend. I'm going to go into the Choose Columns field. I'm going to add a few more things. We do have some of the ones selected I want to look at, but I'm going to add a few more fields. Okay, we do have the IVHV already selected, but I'm going to go ahead and add in the gamma and theta and vega. No one really pays attention to too much. Let's see. Yeah, I was just going to add those in, and let me go ahead and submit that and refresh the page. Okay, now why did I do that? I wanted to show you, and this is something we illustrated in that other archived webinar where we discussed the Greeks and we also discussed the implied volatility. Notice here that of these 5 positions, the system scanned the entire universe of options and identified only those 6 positions that matched our criteria. Really, it was only 2 positions until we took out that simple moving average range. But what are my deltas? Well, notice here we have a delta of negative 0.24 to negative 0.13. So looking for the reasonable probability, looking for that reasonable range out of the money and that percent to break even, we've already, based on this criteria, we're already filtering by delta even though we didn't put it in as a specific criteria. Everything goes hand in hand. There's nothing wrong if you want to use delta in your filters. We're just illustrating that you don't need to go in depth into these types of particular criteria, these elusive sort of Greek criteria, because if you set up a reasonable search for a given strategy, you're already filtering by those factors. The implied volatility. Well, we've kept this in a narrow range from 0.47 to looks like 0.76. Okay, so without screening by implied volatility, we already are. Now the percent implied volatility range is a little bit different. Let me clean this up for you guys here. There we go. Let's select another drawing. The percent implied volatility range. This is showing you where the option's implied volatility is now compared to where it has been over the life of the option. And what we're looking at here is we do see this one here, the Kate Spade Company, which was trading in an uptrend. Stock's at $29.89. The February 25 put is selling for 40 cents. It's a 1.6% yield for a 23-day trade, just on the cusp of my requirement. We have a strong probability, very low delta. The implied volatility is a bit high, probably looking for around 0.5 or 0.6 on average, or that's where the market is right now. But it's currently at its high range of its implied volatility, so it's currently at the high of where it's been. Now, what does that mean? Does that benefit a naked put seller? In theory, it does. Okay, so the idea is if I enter into a naked put, or anytime I'm selling a position, selling option premium, if my option's near its highest range, we have one here at 100, one here at 80, and one here at 51, well, if it's near the higher end of its range, the hope is well, maybe the implied volatility will pull back and revert back to the norm. Well, if implied volatility lowers, that means our premium will decrease, and we can potentially buy it back at a cheaper price. But in general, and of course we see here, let me skip ahead, the IV over HV, investors use this as a measure as the option overvalued or undervalued. If we have an implied volatility ratio, implied volatility HV of greater than 1, that tells us that the option's implied volatility is above the historical volatility of the stock. Many investors use that as an indicator that the option is overvalued. So do I only want to look for overvalued options? Not necessarily. If the option is overvalued and is near the upper range of its implied volatility, that means something's been going on with this stock. I would want to do as we did before. I'm going to have to take a look at the stock chart, the company information, the recent news, headlines, and perhaps also look at the research to see if there's any other event coming up that may cause me hesitation for entering this position. I'm not saying it's bad to trade only overvalued options, but let's take a look here at the one that has a lower volatility. It's in the 16% of its implied volatility ranges for GameStop. Stock's at $37.95, February 35 put at 60 cents, so about the same return, 1.7%. The percent implied volatility range is extraordinarily low, and this is an undervalued option with a IV over HV ratio of 0.83. That tells me that theoretically the market's saying this option is 17% undervalued. Now, of course, if the bid-ask here is 60 cents to $1.05, well, if I get the midpoint, I'm not going to be as much undervalued there as far as that goes. But the reason why I wanted to bring this up is because looking at this particular position, as I go through my due diligence, if GameStop matches the trend that I want, it is only one of the two positions that was currently trading in an uptrend, remember, above the 50-day moving average. But if it matches the criteria, I look at the stock chart and I'm comfortable that the stock's going to stay above 35 within the next 23 days. I don't expect any major declines on the position based on the current trends. And the other information that I'm looking for matches what I'd want to see for the stocks I like to trade and the return that I want and the probability I want. Do I really care if the rest of the market thinks this option is undervalued or overvalued? No, what I'm more focused on is, does it match my goals? Is the stock really in the trend that I want to see? Is this a type of stock that I wouldn't mind owning long term if I am put the stock at $35 per share? I'd analyze that, of course, through looking at the stock chart, the company information, news, and the profile as well. So if you wanted to screen only for overvalued options, you could do that. Whether you use IV over HV or the Black-Scholes ratio, you just put in a range of greater than 1 for both of those fields, just to limit it down to overvalued options. But again, I want to caution you on that. The most important thing when trading this strategy, in my opinion, is making sure that the underlying security matches your sentiment for this position. Got to make sure the return, the premium, match your goals for this position as well. And you want to make sure that in the worst case scenario, that if you were put the stock, this is a stock you would not mind owning long term. That is more important than does the market as a whole consider this option overvalued or undervalued. And remember, let's go back up to that Kate Spade position. With an overvalued range here of 1.95, that means that the option is considered 95% overvalued from its historical volatility, and it is in a high range of implied volatility here, around 0.77%. I would definitely have to do that further research to look to see why is there so much interest in this position. Why is the volatility so high? Is there an expected event coming up? Is there a threat of bankruptcy? And that's always a potential. We've seen a couple stocks declare bankruptcy within the past couple of weeks here. Did they recently have earnings, and the earnings actually dropped the stock from, let's say, 33 down to 29? It's holding at 29, but if it was because it was up at 35 and now it's at 29 and that's why the implied volatility is increased, that's something I want to know. That's showing a strong weakness on the position. I've got to delve a little bit into that last earnings report to see why there was such a drastic drop, and what does that mean going forward, either short-term or longer-term, for that particular position. Okay, now, weekly options. Let's scroll over to that real quick. Basic criteria is the same, right, for the stock. Whether I'm doing 7-day trades or whether I'm doing 30-day trades, I still want stocks that match the strategy sentiment. Want to look for good liquidity. Stock has to match my price range if I'm doing cash-secured positions. Want to look for stocks that have shown good earnings, relative PE. I tend to focus on the mid to large cap stocks and avoid the small cap stocks, and we want to avoid any earnings that would come up between now and 9 days from now, whatever the expiration is of our weekly security. But now we have to change some of the criteria. Well, the first thing I'm going to do is I'm just going to go ahead and go to all weeklies, but I'm going to limit it to 9 days out. We're not going to look at the one that's 2 days out. You saw that we could select that directly. I could select January right now, 2 days out in time. Many of the securities, as you all know, there are roughly 410, 408 securities that offer weekly options. 95, 97% of those securities offer what are known as the continuous weekly options, where you'll have 5 to 6 expiration cycles available week by week by week by week. Okay, so if I wanted to look at the different ones, we could put in a setting to look at least, let's say, 5 days out, so we skip the current expiration out to about 18 or 19 days out in time. So that would show us the next 3 weeks, whether it's 14 days to expiration, or sorry, 9 days, 18 days, or so forth. Okay, but I'm just going to look at the next available cycle that's not this Friday. So let's go 2 to 10 days out in time. And that'll automatically filter out this week's expiration. Let's go ahead and run that search by just making that change. No stock option combinations match our criteria. How is that possible if we have over 400 securities that offer weekly options, and of those weekly options, there's probably 15 to 20 out-of-the-money strikes for almost each individual security? How do we have no results? Well, it's because when we choose the weekly options, we've got to relax our expectations for return and range out of the money. This is literally telling me that there are no positions that are offering a 1.5% yield that are 5% out of the money and have a percent to break even. So let's lower this down and try a range of just 0.5% for the next 9 days. My percent to break even, we're going to drop that down to 3. My range out of the money, let's go to 2%. Let's lower our expectations. We're going to have to do that. We know we're expecting a smaller premium, and we know we can't go as far out of the money and expect a high premium with only 7 to 9 days to expiration. Go ahead and run that search. Here we go. All right, so now we have 19 total results that match our criteria minimum requirement. So we still want the same types of stocks. Okay, now why are we seeing Yahoo here, and we didn't see that when we did the February screen? Why are we seeing Halliburton? I don't think appeared. Intel didn't. Seagate was there. Freeport-McMoRan was not, I don't think, in those last 5 results. Well, the reason why we're seeing them in this weekly screen and we didn't see them in the standard February expiration is because these stocks probably have earnings coming out between now and February 20th. But they don't between now and the 6th of February. Let's do our due diligence. Let's check real quick on Yahoo. Let's go to research here. I want to go to stock research. January 27th after the market. Okay, so they just had the earnings recently. They just had the earnings the other day. So that had already passed. Now it's likely that the Yahoo positions didn't offer the premium we wanted for the standard expiration. It's probably less than 1.5%. So that gives us a little bit of clue. We talked about Freeport-McMoRan. It might be the same thing. Let's take a look. Okay, 127. Okay, so the last earnings did come out before then as well. So these premiums are still reasonable for a weekly trade, looking for 0.5%. But let's use that option chain again to see what we were looking for. I'm just curious now as well. So we got the small chain here, but I'm going to go to February 20th. Look at the out-of-the-money strikes. There's some of the ranges with the volatility. We don't see the probability range that we were looking for until here with that 70% probability. We did have the percent to break even, and we were right on the cusp, okay, with this particular strike. So remember our criteria for our standard expiration. We wanted at least a 1.5% naked yield. We needed at least a 70% probability, 5% out of the money, and at least a 7% break even. Those all matched, but it was right on the cusp of the percent naked yield. So probably in real time it's only 1.4%. That's why we didn't see the Yahoo position with our standard February screen. And of course, going further down, we now don't have the return. Where we do have the return with the 47 and the 46 strike, we didn't have the probability as well. So that's why we didn't see Yahoo in our previous search, but it is here on our weekly screen, and we see some good premiums there at 1.5, 1.2%. So remember, when doing a shorter term trend, you've got to lower your expectation for yield, lower your expectation for protection, how far out of the money, and your percent to break even, but you want to keep the same stock filters that you use to identify naked put positions that you feel are neutral to bullish in price. Now, I had mentioned earlier, I'm going to go back to just a standard expiration very quickly. And I just want to remind anyone, we are at 5 minutes after the hour. If you have any questions at any time regarding any of these concepts, go ahead and send those to me, okay, using the question pod there. I'm going to set it back to February, and I'm going to lower my yield to 1%, my percent break even to 5%, and my range out of the money to 3%. And I'm going to take out some of my stock criteria as well. The fundamentals, I'm going to increase this, in this case, to about 250. I'll explain why in a moment. I'm going to take out the market cap, I'm going to take out the earnings, and I can take out the earnings per share growth as well. For the technicals, I'm going to leave the average stock volume also. But now what I'm going to do is run the reason why I took out that stock criteria, so I'm going to run a screen specifically for ETFs. When you're doing a naked put, remember what we talked about before, the highest return, the highest premium doesn't necessarily mean the best trade. And we want to look for positions that we, of course, feel are neutral to bullish in price. And we don't want to take on anything that has a relatively high volatility. So let's start first. I'm going to go to the list section, and I'm just going to include indexes and ETFs. But at the same time, I'm going to go ahead and exclude, I can exclude leveraged ETFs. The 2 or 3 times are inverse. For right now, I'm just going to exclude the leveraged ETFs. I've created my own personal list where we're using that create modify stock list where I've combined the leveraged ETFs and the inverse ETFs to remove. So let me go ahead and select that actually. But I'm going to tell the system I just want to see indexes and ETFs, but I want to remove the leveraged ETFs, those 2 times, 3 times bull and bear ETFs, and the inverse ETFs as well. Go ahead and submit that. All right, so now we see things such as UNG, XOP. Here we see some of the natural gas ones that have a higher volatility, energy sectors as well. So we have a listing of the oil ETFs, the VXX, of course, as well, with the different yields. Now, with that screen I created, you may be asking, well, why are you not seeing things such as DIA, SPY, QQQ? And it's because they have a lower volatility and they're not likely matching our naked yield range or the percent to break even. Let's lower these down here. I'm going to lower percent to break even down to 3, percent range out of the money to 1, and let's leave the naked yield at 1 as well. Let's go ahead and submit that. Did we get some of those in there now? Well, we got SLV in there a little bit. No, we still only have 16 results. One last trick. Let's lower the naked yield down to about 0.5 for a standard expiration, 30 days out in time. Let's take a look. Well, oh, we've got 4 pages now. Let me do a quick search here. Let's go to fundamentals. Let's try SPY, one symbol at a time. There we go. Okay, so there are more results now, but you see none of the SPY results that were that range out of the money had the probability that we wanted of at least that 70% offered greater than a 1% yield. We had to lower it down to 0.5%. So when you, this is important just to note because it also applies to stocks. When you're looking at ETFs, the standard ETFs, SPY, QQQ, for example, DIA, even IWM to a lesser extent, the Russell 2000, these securities have a low volatility of around maybe 0.10, 0.15, 10% or 15%. Other stocks, water cooler stocks, things such as Johnson & Johnson, Hertz Global, positions of that nature also have that lower volatility. When you have that lower volatility, you're going to have a lower premium and a lower naked yield. So if you wanted to look for extremely large cap stocks with over 1 million or 1.5 million shares traded per day, you shouldn't expect to go 5% out of the money and see a 3% naked yield on those types of securities. You're more going 1 or 2% out of the money and looking for a yield of around 0.5 or 0.6% as well. Okay, so that's just what to expect and how to use the search tool to match this criteria. Whether you want to be more conservative with larger cap stocks and standard ETFs, you've got to lower your expectations even for the standard 20 to 30-day expiration. If I want to do a weekly series on SPY for a naked put, well, I'm probably only looking at a 0.2 or 0.3% yield for something that's 1 strike out of the money or 1% out of the money or more. So it has to match your expectations, okay? All right, let's quickly toggle back now and let's just do a review real quick here on the management techniques. Now, I'm not going to go in depth to management. We're probably going to do that next Wednesday for managing the naked puts and concepts on that. Sorry, Jerry, I know you wanted to talk about it today, but that's one of the considerations as well. So the management techniques, what are the 3 outcomes that can happen if the stock, once we enter the naked put position? Well, number 1, the stock could stay at the same price it is above our put strike price or move up. So with Ambarella, let's say that we entered the put at, we sold a 53 strike with a stock at 58, and over the next couple weeks or so, the stock goes up to 62 or 63. Well, remember my goals were to have the put expire. So as the stock is moving up in price, my put premium is going to decline. It's going to get closer and closer to 0 as we get to expiration. So I could just let the put expire naturally. However, if we sold that, remember, put for $1.50 or so, if over the next week the stock moves up to $61, $62 per share, I might be able to buy to close my 53 strike put for only 30 or 40 cents, maybe 60 cents or so. It still kept half the premium, so I could buy back the 53 strike put and sell now maybe the 55, the 56, or the 57, and maybe generate another $1 in premium now that the stock's trading up at 62. So we could just let it expire, take the maximum return, or we could choose to actively manage it as the stock's moving up, roll our strike price up, buy our put back at a cheaper price, and then sell a higher strike put that we still feel confident is going to expire worthless in the next 20 to 30 days. What happens if we enter the position entered Umbrella, stock's at 58, we sold a 53 put, and the stock now drops to, let's say, 53.50, 53, or $52.50. Well, if we're at or near expiration, of course, we could, if the stock's trading right at 53, it's probably only going to cost us 20 or 30 cents to buy to close that call. Getting closer to expiration within a day or two, premiums decayed out of it. We're slightly out of the money to slightly in the money as the stock wavers. So we could consider to buy to close it for 20 to 30 cents, and then we could roll to a lower strike further out. The stock at 53 now, I may roll down to the 50 strike for March expiration, maybe try to generate another $1.20 in premium. So I made most of what I expected to make on the first trade, and now I'm going to look to go to the 50 strike, a lower strike one going forward. What's our other choice? Well, we could take assignment. Let's say the stock's trading just at $52 per share. We did collect a $1.50 premium. So I could take assignment, buy shares of stock at $53. I keep my $1.55, so my cost basis would now be $51.45 on the underlying security. Okay, so now with a cost base of $51.45, the stock trading at 52, I could sell the 52 call for the next expiration cycle, the 52.5. I could sell the 52 call and maybe buy a 49 or 48 strike put for the same expiration to create a collar, which would still give me a positive upside, but if the stock continues to collapse, I have protection. What Jerry mentioned is also a possibility. I enter the stock, I'm forced to buy the stock at 53, but my cost basis is $51.45. Stock's trading around $52.50. I could convert this into what's called a radioactive trade. I could buy a far out in time put option, let's say at the 52 or 53 strike, and then still sell a near-term 52 call against it. So I have longer-term single-digit protection going forward where I could cross other earnings now on that position and at the same time still generate premium by selling a call or doing another adjustment. Now, what happens in the third scenario where the stock falls well below the put strike price? Well, if there's a sudden unexpected gap and Amberella, for whatever reason, remember we have the 53 put strike, and it drops down to, let's say, $45 or $42 per share, we're probably going to be assigned early and forced to buy our shares of stock at 53. Well, there's not much we can do. We're going to have to try to manage this now with covered call premiums. We could sell to close the stock and take the loss, or we could try to manage it as a collar or as a covered call. If I saw that significant drop and I was forced to buy shares of stock and I didn't want to take, of course no one does, I didn't want to take that 12-point unrealized loss on the position or 11-point unrealized loss, rather than just doing a covered call, which doesn't really address the downside, I'm probably trying to immediately convert this into a collar where I have some protection if that continues to fall after this big gap, so I don't lose too much more, and then I've got to spend 6 to 8 months managing the position. Now, why do I say that? Well, let's again say that we were put the stock at $53 per share, but it's currently trading at around $41 per share. Okay, well, our cost basis, remember, is $51.45. It is trading at around $41 per share. Remember what we saw with this particular position. With Amberella, we were seeing an out-of-the-money 3% naked yield, and with a covered call, we might see a $1.50 to $2 premium going out of the money. But this is an $11, $10 loss. So even if I'm just doing the at-the-money covered call, now that I was forced to buy the shares of stock, and I'm selling the 42 call, for example, I don't want it to get back up where I get assigned early. But if I'm generating a $1.50 for that out-of-the-money call after this decline, it's going to take me about 6 months to make back that $10, probably 7 to 8 months. Okay, so that one decline is going. First off, it's going to wipe out probably 7 to 8 previous profits I've had in naked put positions. Right, when I factor in if I'm only making $1 on each naked put, I take a $10 unrealized loss on this one. Well, that's wiped out 10 previous gains, hasn't it? That goes back to that risk-reward profile that we talked about earlier. So if I am unexpected event, it will happen in this strategy. It's unavoidable. That's why it's unexpected, unfortunately. No stop order would help you in this. No contingent order would help you in this. You get put the stock that's now trading 10, 11 points below your put strike price. You're going to have to look to manage it long-term or just take the loss. But remember, it's going to take you several months with a standard, what we'd expect to see as a standard premium of $1 or $2. It's going to take us several months to even get close to break even on that position. Now, another aspect of how can you address some of the risk on this position as well. Let's go back for a moment. I'm going to change screens here, and I encourage you again, send in any questions that you might have here. Kind of address Jerry's question a little bit there. That's one of the options that we have. We'll get more in depth into management techniques in our presentation next week as well. Here's our profit and loss chart we saw earlier for that 53 strike on Amarella. We know that at any time in a naked put strategy, a naked put portfolio, we can have any number of losses of stocks that drop 20 to 30%. It might not be earnings related. It might not be anything that we could have seen doing that research and analysis. It wasn't about a patent lawsuit. It wasn't about a change of board members. It could be anything that came out here regarding this position that could cause a 20 to 30% drop. It will happen over time. And again, if I take, even with that 10%, 11% downside protection, if we suffer 30% loss, that's still an 18% unrealized loss. Our portfolio is down 18%. Our cash basis is down 18% on this one position. Well, if we're only generating 1 to 1.5% per win, let's say even 2% per win, we're talking about 9 to 12 trades. We've just wiped out 9 to 12 previous profitable trades. Okay? So going forward, what are some of the ways that you can avoid this loss? Stop orders won't work. When the unexpected event happens, it's going to happen overnight or in the pre-market hours. You put a stop order of 10% in the stock drops 30%, you're filled at that 30% loss price. The market can't give you that 10% loss. You filled at whatever the stock is trading at that time. So what are some of the ways that we can protect the loss? Well, the first way is, of course, to convert this into a slightly different strategy. We're still neutral to bullish, but I could convert this, instead of doing a standard naked put, we could do a bull put credit spread. So we'll go to our standard February expiration. We're selling the 53 strike put for $1.55, we're going to say still, 145 bid, 185 ask. I want to take less than half of that, definitely. So let's go ahead and try this 47, let's keep it an even number, 47 strike put here. 6-point spread, of course. But we're going to give up, let's say, 25 to 65, so let's call it a 45-cent ask price. Okay, so we're going to buy one at a midpoint of 45 cents. Now, this adds some potential protection. We've taken our max profit on this position from, from 155 to only 110, but now our yield has spiked up to 22.4%. Why did that happen? Well, because we bought this extra put, even though we sold the February 53 put, which does enter us into an obligation to potentially buy shares of stock at $53, we also purchased a 47 strike put as well, which means that if the stock gaps down below 47, if it drops down to 45 overnight, 42 or $41 per share, we reserve the right to force someone to buy our shares of stock at 47, so the max we could lose on the position is $490. We keep the 110. We've lowered our premium from 155 to 110 by adding this extra put option into play. But because our monetary requirement now is not the full $5,300 for one contract at the 53 strike, we'd only have to put up $490 to cover the obligation of our spread position. So now we can make 110 off of a requirement of 490, which would be a 22.4% yield. Of course, I can now increase my contract size if I want to based on this position and still collect a good premium. As Jerry mentioned, another way to do this long term is you could enter it into a calendar spread by buying a farther out put option, so that if you were put the stock, you still have that long-term put in place, but it changes the dynamic of the position. You have a much lower max return now over time, or in the shorter time frame, but over time you're going to look to mitigate that by continuing to roll the position. Is one strategy better than the other? Well, it depends on what you're looking to accomplish. What is your account size? What are your requirements for return? And what is your risk threshold? Now remember, I just mentioned that because if you're doing a full spread portfolio, even though you have the lower margin requirement, look at this risk-reward profile. It's a 5-to-1 risk-reward ratio. So if you have one trade go against you, you only lose $490, but that's wiped out now 5 previous successful trades, 4.5, 5 successful trades. A lot of times what we see the bull put credit spread portfolio or bear call credit spread, looking for the higher probability, the risk-reward is around 10-to-1 or 9-to-1 as well. But this is one of the ways that you can help mitigate the loss, one of the most popular ways to help mitigate loss if you're concerned about your position, your naked put position, is to enter it as a bull put credit spread first, hey, if the stock drops, you're still bullish on this long term, and it drops right to around 52, well, this option would expire worthless now. The 47 put that we bought, the long put that we bought to convert the bull put credit spread, that would expire worthless. But we still, if we don't adjust it, we still have the obligation to buy shares of stock. So again, if my expectation is neutral to bullish, and I want the stock to be trading, I assume the stock's going to be trading above $53 per share in the next 23 days, but it happens to drop below it, even if we're in the bull put credit spread, we'll still be forced to buy shares of stock that we potentially wanted to. So now our cost basis would be 53 minus the 110. We'd have a cost basis of $51.90 with the stock trading at around 52, 52.50 or so. So we could still follow those other rules, buy a long-term put, or just buy a put near-term and sell a near-term call against it, or just convert it to a covered call as well. So that's what you can look for with the management techniques. We'll talk about that a little bit more in depth next Wednesday at 12 noon Eastern Time, and we'll show more of the Power Options portfolio tools to illustrate how they're going to help you do all the heavy lifting and all the calculations for you to evaluate what would it look like if we did convert it to a covered call or simply rolled the put, and what are our other options if a naked put position starts to go against us, or as we get to expiration, the stock is right near or right around our put strike price as well. Now, all that being mentioned, let me go back over to the main home tab real quick, and I'm going to click on the free webinars tab. This is where you can go. It's a public page. Excuse me, folks. I'm going to send the link to everyone. Oops. There we go, powerup.com/webinars.asp. This is a public page, but if you're logged on to your account, you can simply just click the free webinars tab. Today's presentation, of course, is going to be listed under the Option Strategies menu. So we have parity trades here. Here's an older presentation where we discuss covered calls versus naked puts. You're going to see the intro to naked put, or this particular naked put position here. And then next week when we do the management techniques, you'll see that there. We also have positions on what is a vertical spread, managing your spread positions, protective option strategies, and so forth. Earlier, we had discussed the criteria where we just talked about the Greeks. Well, under the Options Concepts tab, there's that archived presentation, Greeks, and why we feel you may not need them. And, of course, talking about implied volatility, the double-edged sword. So some of the concepts we talked about today, why I don't necessarily consider looking for an overvalued option when I'm selling or an undervalued option when I'm buying. That's all discussed there when we talk about implied volatility, the double-edged sword aspect of investing as well. All right. So just want to remind everyone real quick, the Power Options subscription services, this is what you get when you subscribe to Power Options. You have access to all of these tools for these particular strategies, access to all of the help information and our knowledge of options trading, our 20-minute delayed service, access to all 23 different strategies, the search and analysis tools, and of course the portfolios for tracking and managing the positions. That's only $60 per month. You can upgrade to the 20-minute delayed plus access to the historical tools for back testing. That's $100 per month. And of course, we do offer a real-time service where every time you refresh the page or run a search, you're getting the numbers and calculations at that very instant. The real-time service is only $100 per month. And then the upgrade, the real-time plus historical suite of tools and access to the API is $140 per month. We have regular webinars, of course, on options, strategy, and discussion, as well as the various tools. And every Friday at 4:30 p.m. we do host an open discussion presentation, open forum, open discussion presentation as well. Well, ladies and gentlemen, thank you again for joining me today. As I mentioned, we're going to post that webinar, the recording of today's presentation. It'll probably be posted around 5 p.m. Eastern Time or 6 p.m. Eastern Time this afternoon. So just go to the webinars page, powerup.com/webinars.asp. and click on the free webinars tab there and look under the options strategy section for today's discussion on the naked put trades. But if you do think of any questions later on, please feel free to contact us at any time. You can send me an email to support@poweropt.com. You can call us toll-free during market hours at 877-992-7971 if you live inside the U.S. But if you live outside the U.S., you can also reach us during market hours, U.S. market hours at 302-992-7971. There's also contact links on the bottom of every Power Options page. Thank you again, ladies and gentlemen. I'll post and remind everyone about the webinar coming up next week, Wednesday at 12 noon Eastern Time again. We'll be discussing management techniques for our naked put positions and try to avoid some of those losses that may appear. And also, of course, Friday you can join us for that open discussion free presentation where I don't have any planned material. We just handle questions from our attendees on the fly about options trading, power options, and other various option strategies as well. Take care, everyone. Have a fantastic trading week. We'll see you soon. Good night.